All right, welcome everybody. It looks like we're right on time today, 11 a.m. Pacific, 2 p.m. Eastern time. I've got the webcam on there so you can see I'm real. Good to see you, everybody. Thanks for joining us. Looks like a lot of people jumped in the last 1 minute or so. So thank you everyone for attending. And wow, I could go through, well, a lot of names, but I won't. I see Oliver and Ellis and Loy and French and Lynch and Betty. And anyway, so thank you all for attending. And we're going to get this show started. We're right on time. We're going to talk about options trading, how to simplify your life with automation, trading options the smart way. We have a proprietary algorithm that allows us to generate trades and also manage them for risk and reward. So I think you're going to love to see this. We're going to do a demo, and you can use strategies for non-directional situations or bullish or bearish, and we're going to show you the most incredible trade alerts that you've ever seen. I've never seen anything like these. So thank you to Investor Expo for having me here. They always put a great event together. So remember, we are speculating, and speculators always have to accept risk when you're trying to profit. So do take a moment here and read that risk disclosure. It is important. Remember that past performance is no guarantee of future results, and only risk capital should be used when speculating. A little bit about Altavest. Since 1997, we've been trading as a registered introducing brokerage firm. That is yours truly there in the middle of some of my colleagues down on the trading floor, the S&P 500 options pit. Those are some of our floor staff, floor brokers that worked for us and with us, I should say. So over 25 years, tens of millions of contracts traded over those years, a lot of experience. We're futures and options. We're in a highly regulated industry, and that's to your advantage. That means we're audited at least yearly by regulators. We're registered with the CFTC and a member of the NFA, and we're located here in California. And just a bit about myself, I'm Eric Gebhardt. I've been doing this about 30 years now, co-founder of Altavest, and since 1991, I've had my Series 3 registration, and I have a BS in Business Administration, my degree from USC, University of Southern California, the Trojans. Maybe you've seen some of our presentations in various other venues. Here's a sampling. And if not, hopefully you're in for something informative and useful. I think you'll find it. Usually everyone will say they learned something. So hopefully we can rise to that level again. So I got started in mutual funds and annuities out of graduation. So I had my Series 6 and 63 securities licenses. And I won't bore you with all this. I, of course, have my Series 3 commodity futures license and also my Series 65. That's the investment advisor law exam. So those are the preliminaries, a little bit about us and our background. And with that said, just to give you more room on the screen, I think what I'll do here is I'll shut down the webcam. And that way you get a little more room on the screen since the introductions are out of the way. So what is the current financial landscape, the economic landscape? This is a good summary here. Mortgage rates above 6% in the last since the last 14 years. FedEx warned about a huge slowdown in shipping, computer chip producers falling on weak demand, housing prices down 6% in 2 months, credit card debt escalating up 30% in 4 months. Recession is an understatement, and there's more of the same. Rates rising at fastest pace into a recession, by the way, which has never happened before. Mortgage rates, their highest since 08. We saw that. FedEx, credit card debt, worst energy crisis. So how do you actually navigate and trade in this environment? Are you going to try to day trade and pick stocks? Are you going to be a stock picker? Are you going to try to sell the highs and buy the lows and all these movements here? We are not doing that. So this is what we do not try to do. And part of the reason is this: day trading, there's a less than 1% success rate according to various studies. Great article here, Day Trading Pandemic. Less than 1% of day traders in this 15-year study were able to consistently beat the market. That's a study out of Taiwan. Even Charles Schwab, they looked at their active trading accounts and they substantially underperformed a simple low-cost index fund. And even out of Brazil, 3% of the day traders made money, so on and so forth. So it's not easy, folks, and day trading, of course, requires you to sit by that screen all day, or at least for a large portion of it. But how do the professionals do? Well, it's even difficult for them. Last year, 79% of active fund managers underperformed, and over a 10-year period of time, 86% of active fund managers underperform. And look at this, BlackRock, they lost 1.7 trillion in the first half of 2022. And this was just the other day I saw this Danish pension fund lost 36.4% in the first half of 2022. So even the people that are doing this full time as basically to make a living off of this full time are having difficulty. So maybe social media can help? Well, maybe not, folks. Remember, staying popular means you never criticize stocks, especially a meme stock. And this is kind of disconcerting. 2/3 of adults have been investing for less than 3 years are using social media to make their stock decisions. So that's probably not a smart thing to do. You probably don't want to listen to this kid here, no offense to him, but he says real estate can make you money out of thin air. Well, this guy here is with the Rolls Royce, talking about big money here. But remember that day trader army that emerged during the pandemic now says here, all the amateurs investors who jumped in when the lockdown began have now given back all their gains, according to an estimate by Morgan Stanley. So that day trader army is broke. Here's a good example. This guy here obviously had wealthy parents, gave him $500,000 to invest in the stock market. Now he's down 96%. Of course, you don't know if any of that's true, but I think we get the point. This is not for amateurs. But what about the pros? I'm going to pick on Jim Cramer and Cathie Wood of ARK. And why not? They put themselves out there, so they're in the public realm. But March 25, Cramer says the bear market's over. Well, look at that arrow. Here's what the market's done since. I think we're probably headed to new lows, but we'll get into that soon. And here's some of his commentary along the way earlier this year. Basically, every time it makes a new low, he says it's now the time to buy, as it just keeps making more and more lows. Here's another one just last week, September 11. He says, we've seen the lows in this tough market. Well, that's right here where he said it. And then, of course, we've collapsed since then. The next 2 days later, the market was down 4%, worst decline in 2 years, worst day there. And look at this, Cramer predicts FedEx will have a great year among strong e-commerce sales. Here's where he predicted that. And of course, FedEx has dropped precipitously since then. Even the CEO here says it's going to be a worldwide recession. So Cathie Wood, she says the bottom was January 27, right here in this red arrow. A little bit of chop here and then down, down, down. Although they're having big outflows, we don't need to worry about all the details. They're trying to buy the dip here last week. We'll see if that works. And crypto, well, you see Bitcoin up near 70,000, now below 20 last time I looked. And this kid here says he might be down 10,000 today, but in a year he'll be over $1 million. So we'll see. But basically the point of that is to say that's all narrative and storytelling. There's no process, there's no math involved in any of that. There's nothing quantitative. That's just storytelling, selling hope and dreams. So if you are going to day trade, or even let's just say trade at all, can you even beat the market if you're trying to pick stocks? Well, it's not that easy. Here's simulated portfolios with 100 portfolios, and just random stock picking outperformed the benchmark by an average of 1.7% per year. So there's your best hedge fund manager, folks, right there. Love that guy or gal. And emotions, I think that's the next hurdle to overcome. Probably the biggest one is us. It can be expensive trying to convince the markets that you are right. According to Ed Sequoia, he's a pioneer in systems trading. Great book, Market Wizards. He's featured in that. Do not end up like this, arguing with prices and arguing with the screen as you go into the grave. Stay off of the emotional roller coaster here. So don't get euphoric when you're winning. Don't get despondent if you're not. It shouldn't really matter to you one way or another if you're following a process and it's repeatable. So you want to stay off of this ride here. And Motley Fool kind of summed it up nicely. Our worst financial enemy is us. So we make these three common, basically, mistakes. We have these biases: confirmation, anchoring, and recency bias. And I think this one graph here, or this image, sums it up very well. Things are going well. We tend to think we're really smart, and maybe we shouldn't. We get overconfident and bad things happen. But anyway, so remember this: the algos are dominating the landscape. 90% of stock market trading is basically machine driven, according to JPM. And I do have a lot of, just aside, I have a lot of slides here, and a lot of them are just pictures and images, and we're going to get into the demo in just a second. So we're going to just go fairly quickly to get to the meat and potatoes here, but I do want to provide context as to what we're doing. So, okay, so that's called revolutionary trading. Here's where we are now. A lot of machines are taking over. This is what it used to look like. Yep, people are, and by the way, be sure to jump in with comments and questions along the way. I'll do my best to get to them over time here. But yes, that's what it used to look like. I took that a few years back, quite a few years back. But here's our competition now. This is what you're competing against. Even if you think it's just another person like you on the other side of a screen somewhere, that's really a minimal part of the volume these days. So non-emotional machines, automation, built-in risk and reward controls. So with that said, I want to jump into the options part of this here. That's, of course, what we're talking about mostly today. But let's look at insurance companies. How do they make money? And maybe what can we learn from that if we're trading options? Well, the insurance companies collect the premiums that you pay them, and they're assuming risk that you don't want. So they essentially sell and manage time, and they always insure themselves against a move, or let's say a market moving against them. They're hedged. They're consistent and they're patient, and they have a process. I should underline process. And that's really math, probabilities. So statistics, actuarials, quantitative number crunching, that's really what they're doing. So how can we collect premiums ourselves if we're trading options? But that's what we call a base hit, collecting premium. We sell options or go short. Need to be consistent and patient with our approach. Manage risk, expect to have losers. And then manage reward. You don't want to be greedy. It's just as important. But you need the proper tools to make this happen. So remember, we're not swinging for the fences here with grand slams. We're not trying to crush it with 10,000% returns. That's really ridiculous and absurd to think that's a sustainable way to trade. So we're looking at short option strategies, premium collection. You see the blue, the green, the bear, basically any market condition, we have strategies for that. And of course, these outcomes have predetermined risk, and that's important, and I'll show you that in just a moment. These are called credit spreads. You simply collect premium, and each position is insured with predetermined risk and reward before you actually place that trade. And they may be non-directional, remember, up, down, or sideways. We have strategies for that. Now, this is important. We're talking about trading options on stock index futures markets, and we're not trading individual stock options. And there's several good reasons why. These are the top 3 reasons. An index is always less volatile than an individual stock. Number 2, there are strategies for any direction when you apply it to an index. So if you have a portfolio, an index is a great tool to use for perhaps hedging that portfolio or even adding directional strategies. And then if you're trading an index, maybe you're just trading that one market and you're not having to track thousands of different stocks and ETFs. So that's another big time saver there, another big benefit. Now there's a wide margin of error with a lot of these trades we'll look at, and these are futures options, and don't worry about this chart. I'll show you in 5 minutes what it means. But here's the upper boundary and here's the lower boundary of this trade. And you're really looking for the S&P in this case to stay in this wide range over a period of time. So you have a lot of wiggle room on that trade. Before we jump into the demo, I want to show you two things about the Greeks, as they are referred to with options trading and options parlance. The first is delta. That's simply how much the option value changes with a change in the underlying asset. And it's also the approximate probability of that option expiring in the money. So if a delta is 0.25, at that moment, there's a 25% chance it would expire in the money. However, conversely, the opposite of that says there's a 75% chance it expires worthless. Remember that delta number is always moving, it's not static, it's moving almost as quickly as the price of the underlying asset. And of course with time, and speaking of time, I'll show you that in a second, but remember delta is not the probability of a winning trade. So keep that in mind as well. That's an important point to remember. And now the other one is theta. And this is all we're going to talk about in terms of the Greeks. That's all we need to know right now. Theta is sensitivity or time decay. Remember, options have a limited lifespan. So when you talk about theta, that's really a negative number referencing 1 day of time decay. And you assign a value to it. So if an option's at 10 points, theta might be negative 0.05. So based on theta decay, the next day the premium would drop to 9.95. The next day it would drop to 9.90, etc., etc. So here's what it looks like on a graph. So you see as you approach time 0, the percent of that premium remaining drops and drops and drops, and of course, eventually you run out of time. Now, if you are only buying stock options, remember theta time is against you. So here's a link here to this, actually a CNBC video I found the other day. I thought it was actually very good. So I'm going to give you a few screen captures here. This woman here, I think she's an analyst. I forget which firm, but says the appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. So what is she talking about? We're going to talk about that in just a second. So she's going to talk about trading spreads. So you have to sell options just like professionals do. So a spread means you buy and sell an option at the same time, typically. So it says an option spread, you would buy and sell different contracts. It's a very common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. How about this? This is interesting, folks. In 2021, 11% of Robinhood's active users made an options trade, but of that, fewer than 1% actually made a multi-leg options trade. So they are not trading like the professionals. That's the moral to that story. So let's look at how professionals would trade options, and we'll look at some multi-leg option strategies. This is a real simple strategy, selling a call spread. This red line, you sell this call here, the 45.50 call, you receive 4.5 points. The blue line, you would buy, pay money for that, the 45.70 call, and you pay out 2.25. But the net result, the math says you collect 2.25 points, put that in your pocket. That's $112.50 minus your commissions, of course. So basically you want the market to stay below this upper boundary here, this red line between now and expiration. And selling a put spread, just the opposite. You're selling this put spread out of the money. In this case, you collect a net premium of $100 and put it in your pocket, and you look for the market to stay essentially above that red line. These are not naked options. Remember, we talked about how insurance companies always insure themselves. So these options that we're trading, these spread options, I should say, are covered spreads. So no naked trading allowed, folks. And here's a really two big advantages. I think the first is obvious, but and the second, or probably should be obvious, but the first one here, no margin calls. If your risk is covered in advance, then the market won't trade you. You don't want to throw good money after bad, and you don't want to be scared out of a position and have to add money to it to hang on to it or close out a trade because of a margin call. So we're only doing covered spreads. Then that means, of course, your risk is limited before you place the trade. Here's an iron condor, and it's very simply a combination of the put and call spread that we just saw. It's a non-directional strategy, and this is what it looks like on a graph. You sell this call and put spread. You look for the market to stay in this range. And that's kind of how a condor works. So we're going to jump into the details. And before we do, let's look at this one other position here. This is really, people have called it weird. We take that as a compliment. And it's called a dragonfly. We came up with this strategy ourselves after trading with thousands of clients and doing millions of trades. This is one we sort of crafted. It's a proprietary strategy. It's a variation on the condor. I'm going to slow down a little bit here and go through this. So here's what this is structured like. One dragonfly is structured this way. You sell 4 of these calls here, the red line. You buy 3 further out and 1 closer to the money. You have the same structure with the puts. You sell 4, you buy 3 further out, and then 1 closer to the money. And then you look for the market to stay within that range. And you collect a net premium on the calls and the puts. And I'll point out something here. You can't quite see it maybe, but I'll point out the put and the call that you buy. Remember, you buy this one call and this one put. In this case, it's 50 points closer to the money than the ones that you've sold here and here. So you own this call and this put, and they are much closer to the money compared to the ones that you've sold. So this creates a totally different risk and reward dynamic and profile on this trade compared to the condor in certain circumstances in particular, and we're going to show you that. How about a couple of unique bearish strategies? How about just doing half a dragonfly? So you can just do the call side of a dragonfly, for example, and look for the market to stay sideways or go up even a little bit or just drop a lot. Then you collect the net premium on that. Here's something we call a bear hedge. If you've never heard that name, it's our name. And quite simply, it's you sell an out of the money call spread, you collect that money, and then you use that money to finance the purchase of an out of the money put spread. So that's what you call a one-to-one bear hedge. So we're going to jump into the demo in just a second. So you're probably thinking, how do you create these spreads? Which market do you apply it to? What strategy? At what price? You know, what's your timing? How do you manage it? How do you manage the risk and the profit? So we'll look at some automated options technology for all these different market conditions. The answer is called Theta Trader, pre-built option spreads. We have a proprietary algo that creates what we call theta trades on a daily basis, advanced strategy automation, bull bear, sideways markets. Then you have the automated risk and profit tracking. And we have a color-coded indicator. It's called the RTI, Risk Thermal Indicator. And we're going to show you how that works. So simple and effective option spread creation and profit and risk management. So Theta Trader delivers these algo-driven option spreads, all market conditions. And let me jump over, if you give me 1 second, I'm going to share my screen here for Theta Trader. Okay, you are now viewing my screen. This is the Theta Trader dashboard. Very simple. That's by design. Not a lot of bells and whistles and unnecessary fluff and charts and graphs and whatnot. So the top portion here are theta trades. I'll explain that. These are any open short or sold spreads that you might have. And these are open or long bought spreads. This is your account info here, and this is integrated directly with your Altavest trading account. So remember, this is Theta Trader is the platform that we developed, Altavest developed, so it's for our clients. And then this is any current quotes right here. And let me explain what this means here. You have bullish strategies that are pre-populated, bearish, and of course non-directional or neutral. And we're trading these three markets. They're all E-minis. So these are futures indexes. So we're trading futures options. So the E-mini S&P 500, NASDAQ 100, and Russell 2000. And why don't we start off with looking at the theta trades and look at the iron condors for today. So these are all pre-built for us. The computer essentially has decided on 16 to 60 days till expiration. Those are the trades that are being pushed out. And you'll see all the strike prices are pre-selected. And this is your maximum profit potential at expiration here. And this would be your targeted annualized return at expiration. And one note on this percentage figure, that TAR figure or TAR is simply to compare one trade to another, not to suggest you're going to generate 264% annualized returns, okay? And also, every trade we place, in this case, like these condors, would be exited before expiration. So I want to point that out, and I'll show you an example here. I'm going to click on this 60 days till expiration, November week 3 condor. All right, so it pulls up a table, and this is all the details of this trade. It might look complicated at this very moment, but let me show you how simple it is. You can see a graph. Here's kind of a helicopter view. Here's the call spread you're selling and the put spread you're selling. So you can see the difference between the 33.60 put and 44.20 call. So that's over 1,060 points between the short strikes on this particular example. So 60 days till expiration, your expiration date, settlement value, premium collecting, risk, commission, capital, cash required. Let me show you this here. The cash required here, 883, and the profit potential here, 116. Then you have your targeted return on cash, just over 13%, and the targeted annualized return. And all of these figures, by the way, are net of all commission. So all percentages and dollar figures already account for all commissions. Let me see if I can, hopefully that helps a little bit, make it a little bigger. I know that I get annoyed if I'm watching a webinar and I can't see anything. So maybe that helps you out. So let's take a look here. This put that you're selling is a 33.60 strike, has a delta of 9.79. So remember the delta, that means there's over a 90% probability that this put will expire out of the money. Look at the call, 6.82. So that's over a 93% probability that this call that you're selling will expire out of the money. So these are those higher probability outcomes that option sellers like. And it always defaults to a quantity here of 1. So maybe you can raise that to 2 or 3. You can see the cash required goes up or down. And the cash required is simply your maximum risk if basically the world ended minus your premium received. And then the value at 2 3/4, we'll just leave it at that. We'll do 4 of these, and we'll just go ahead and place that order right here. And there it is. And this is just a demo account, by the way, so don't make too much of the positions one way or another. So you can see here, it just assumes you're filled at that price in your demo account. Now let me go back and show you we just looked at the iron condor here and all of the theta trades for today. Why don't we look at a dragonfly? So here are the dragonflies for today. We'll look at the November end of month. I typically choose the one with the longest days till expiration when I do these demos. Again, here's an overhead. The calls side of the trade, the put side of the trade. And you can see all of the similar data here on the Dragonfly, except you'll notice instead of 4 legs, you have 6 legs to this trade. And you'll notice the cash required is higher, and that's because you're selling 4 calls and 4 puts, not just one, like in the Condor. You'll notice here your targeted return on cash is a little bit less compared to the Condor, and so would the TAR figure. And that's simply because, remember, you pay money to buy this call and buy this put. So that's additional insurance that you're paying money for. So that's an additional hedge on that position. So you sacrifice a little bit of potential reward. And again, the put that you're selling, 9.83, the call is 6.74. So you have over a 90% and 93% probability that this put and call will expire out of the money. And if you want to do maybe 2 of these, we can raise that to 2. You can see your cash required moves up or down, but it's about $5,000 for each Dragonfly for margin, and each Condor is about 1,000. We'll go ahead and do 2 of these and place that order, and there, just assumes we're filled, just that easy. Now, let me show you the difference between the Dragonfly and the Condor. There's a trade simulator right here. It's like a time machine for these 6-legged option spreads. So it's a very, very unique feature to Theta Trader. Never seen backtesting with 6-legged option spreads before, and I've loaded some already to save some time, just to demonstrate some of the key differences. So here's a Condor end of month April for this year. You can use these buttons down here to go forward in time, and you can see each day that goes by, the trade is sort of playing out day by day. You see the color here of the RTI, that's green, and that means good, do nothing. We'll use this button to play. Okay, so this trade worked out, probabilities were on its side, and it worked out, it turned blue. That means take profits. So with 29 days till expiration, it matured enough and you were able to take profits. Now I want to point out something very important here. You can automate this. So Theta Trader will be scanning your account, and when you have a blue RTI, a profit taking signal, it will automatically transmit the order for you to close out that trade. So, and I'll show you how to do that in just a second. Now, what if you had placed a Dragonfly in that same day? Let's take a look how that would have performed. Look at this. It actually turned profitable on March 21st with 40 days till expiration. And this, you had to wait till April 1st with 29 days till expiration. So you can see how the Dragonfly, there are times where it is going to mature more quickly compared to the Condor, and that allows you to take your money and run, basically, go on to another trade. So the Dragonfly will have behavioral characteristics, sometimes very unique compared to the Condor. And here's a March Condor placed on January 2. Kind of forget exactly what happens here. Okay, it turns yellow, more elevated risk. Trade is a little negative, and that makes sense because it's getting closer to that upper boundary. But at the same time, there's theta decay trying to help us out. And then it gets orange, more elevated risk. More orange again, back to yellow. Orange is kind of making you scratch your head here, isn't it? but Theta Trader says don't do anything yet. Finally, it turns red. That means you've taken a loss, and or at least Theta Trader says the risk is too great. And again, you can automate this. If it turns red, Theta Trader will place that order for you to automatically close out the trade. Too much risk on the trade, get out and take your loss. So that was the March 2020 Iron Condor. And let's compare that to the Dragonfly. So again, you get some elevated risk, but still do nothing. And look at this, it turns blue. Gives you an opportunity to take profits. So instead of ending up with a loss on the Condor where it turned red, had you done this Dragonfly, you would have had a chance for Theta Trader to generate that profit-taking order for you and then move on to the next trade and avoid that loss that you would have had on the Condor. So here's a bear hedge. We looked at that briefly 10 minutes ago. Let's see, I think, yeah, I wanted to show this one here. Just kind of let it play out. Yeah, so here's an example of a bear hedge. For example, you placed it on January 4, had 56 days till expiration, and maybe you were thinking the market is going to drop, or you wanted to hedge some other positions in your traditional assets in your portfolio there. So you could have simply done something like this where you sell this out of the money call spread, and the money you collect for that, you buy an out of the money put spread. And you can see here how the market ended up cooperating in this case, and you hung on to that trade, and it turned out to be a nice winner for you. But of course, anywhere along the way, you can see the P&L was green here. So really just wanted to point out how the bear hedge might work for you if the market moves in your favor. And you can do the half dragonflies. So there you go, turn profitable, take your money and run with 49 days till expiration. And this is very similar to just selling a two-legged call spread. Same kind of conditions. So I just used a Dragonfly here, but you can see how that trade obviously worked out well. Here's another Condor. So you can see here, it's getting closer and closer to the upper boundary. The trade is negative, the P&L is negative. You're getting elevated risk on the RTI, but don't do anything yet. And then finally you get that too much risk, take your money, take your loss and go on to something else. So again, you can automate that. And I want to point out, that's why I'm showing you the winners and losers. I don't want to just make it seem like I'm showing only things that work out well, because we know that every strategy has risk. There's always a hole in every trading strategy. But here's a Dragonfly. Look at that though. The Dragonfly gave you a profit-taking signal. So again, that's the difference. So you see that end of month January Dragonfly compared to that end of month January Condor. The Condor ended up being a loser. It didn't generate a profit-taking signal, yet the Dragonfly did. And that's, again, you own this call here. And that's why. That made all the difference. It's gaining in value. So that helped a lot. In this case, it was 40 points closer to the money. So you can see that made a big difference. And here's how you do it, folks. Right under your settings here, you just go to settings and you click this button to activate the risk manager, activate the profit directive, and then you save your settings. And that will then automatically monitor your account. And whenever there's a red or a blue RTI, whichever comes first, the algorithm here will generate that order for you to close that out. And then here I want to point out we have proprietary research also found under here, TradeScope. might help inform you a bit with some of the direction. And if you've, this is only for clients, of course. And we also have something called our daily commentary. So we follow what's happening in Asia and Europe, kind of follow the clock around the globe, looking ahead here, looking at the calendar, so on and so forth. So we have that proprietary research available as well. And this is a great help file that's all under here as well, under help. And you can see here the color coding for the RTI. Won't go into all of it, more explanations here on the various spreads. And then there's also tutorials. So there are videos available for Theta Trader as well as options trading in general. But really, Theta Trader is so simple. I don't think you'd really need any of those tutorials. So let me go back here. I'm going to jump in perhaps to the best, really the best feature of all for Theta Trader. And one other thing here, I've got just a second. If you want to start from scratch and build your own trade, you can. Or want to point out too that just pick a random trade here. You are able to modify a trade if you'd like. So I just want to point that out because people always ask. And although I think it kind of defeats the purpose, but see here, you can change the strikes up or down. And Theta Trader will tell you, they'll give you warnings on if it's too much margin or whatever, but you can alter those strikes right there. Okay, so let me jump in to what I think is probably the best feature of all. Give me 1 second, folks. And I see some questions coming in, so thank you very much for all that. Yeah, a lot of good comments. I see people commenting on emotion and people commenting on the different strategies, butterflies, so on and so forth. But we'll get to all that in just a second here. But yeah, keep the questions and comments coming, good, bad, or otherwise. Really, I can handle it. And let me make sure you are viewing the right screen. Yes, okay. So how do we make Theta Trader easier? How do we make your life easier? Really, this is why we're doing this, to hopefully give you a tool that will make things much more simplified, taking something complex and making it simplified. But we have trade alerts, one-touch responsive trade alerts. So you simply touch, accept, or reject on your smart device. So these alerts are live, meaning they're integrated with your Altavest trading account. You just touch a screen, green or red, and then that's all you have to do. Here's an example. I'll show you one more maybe in just a second, but you'll receive a text message or email. There'll be a link. You just touch that link. Takes you right to the alert page. Probably hard to see it here, but you'll see a graph and you'll see the cash required here. The quantity is already pre-selected for you and your account. These trades will be tailored individually for your account. You're not going to receive an alert if you already have that same trade or you already have a very similar trade, for example. So the strikes will be different, the expirations will be different, the market might be different. Oh, excuse me here. So you would take a look at that, decide if you want to accept it, or if not, you reject it. Just that simple. I should probably do another video here of a better, more zoomed in version. This is an older one. Actually, it's closer, but it's a couple years old, but you know what? It doesn't matter. It's all the same. But you can see you get a description maybe of the trade itself. You get a graph. You can see here the premium you're collecting, the cash required. You're selling a quantity of 10 of these particular condors. You can see here days till expiration, targeted annualized return, current price on the market. And again, you either accept it or you reject it. Just that simple. And then our technology handles everything else for you. If you accept it, the order gets filled, then Theta Trader will again start to track it. And if you've chosen to automate your profit directive and risk manager, like you saw just a minute ago, then really it's pretty much hands free for you at that point. So it's time. I've done a lot of talking, and hopefully you're not sick of my voice yet. And here we go. Here's a special offer. Your Theta Trader membership, of course, includes everything you've seen with the software, the Theta trades, the RTI, the trade simulator, all of that together. That software is valued at $3,588. And then, of course, the trade alert functionality is part of that as well. So those trades are tailored for your account. They're integrated with your account, meaning those are live alerts. You just accept, and that's all you have to do, or reject. Then the RTI can then basically manage that trade for you if you've elected to use that directive. So that value on these alerts, 44.64, I've never seen anything like these in the marketplace. So the software, including the alerts, valued at over $8,000. But here's what really makes us different beyond just the software is you have us. We are real people, experienced and licensed. You have basically someone to help you with your trading. Call us a coach, call us a broker, call us what you will. Co-pilot might be a better word. You'll develop a relationship with us. Again, we're licensed and experienced. We've traded millions and millions of these spreads. I mean, millions and millions and millions. How valuable is that to you to have someone you can call directly, not just an order clerk, not just someone who's, kind of fresh off of some sort of online education. So we're the real deal, folks. You get all that with your membership, the software, the alerts, and that private coaching valued at over $7,500. That's way undervalued, by the way. I know I talk to people, they've paid $50,000 for a system. They paid $25,000 to get educated through some online course, and that's all good and well. But what I'm telling you is we provide you everything you need with your Theta Trader membership, valued over $15,500. And just to get a little bit corny with that bonus stuff, remember I mentioned we have proprietary research that's only available to clients that's specific to using Theta Trader and the types of strategies we like to use. People really like to just scan through these because we make it so simple. We don't go into a lot of gobbledygook or anything like that. It's not overly technical. Valued almost $3,000 a year. And I mentioned those video tutorials as well. That's just part of it. So you have Theta Trader, the alerts. You have us as your private coaching. You have that research, all proprietary, valued over $18,500. And we used to offer this for $4,000 in-person events. We'd have people coming to the back of the room at a big table and signing up all the contracts and so on and so forth. But these live webinars are a great opportunity for us to reach out to people from really all over the world. So we can make this available at a much, much lower rate. We've done $797 before, but you know what? We'll do even better. And again, this is partly, really the big part of this here is it's live, and we want to reward people for showing up to a live event. 80% off retail, one low payment, $597. So that's it. That's a lifetime membership. So here is your link, cf.altavest.com/TT. Let me see if I can type that in there. Okay, so you can take a look in the chat box there. You'll see the link. Oh, I think I see it already earlier. That's great too, but thank you for that. So cf.altavest.com, that's our link. That's my phone number, but you can simply go to that link and sign up with the order form. And you have no excuse, folks. If you're thinking this is something you want to do, there's really no reason or no excuse not to do it, especially with this 30-day guarantee. I mean, quite frankly, selling memberships is not the core element of our business. We're a real professional firm here, helping our clients as best we can. And the idea that, we're going to have someone sign up and then they say, well, something changed in my life and I can't pursue this. And, that happens, and we're not going to keep your money. We don't want your money. We're not going to twist your arm. So that's a short way of saying money back guarantee, 30-day money back guarantee. A few FAQs. And I know I've got a bunch more probably in the questions pane that I see, and I think I'll get to some of those here. All right, so let's see here. Tax efficiency, maybe something you hadn't thought about, but trading futures options compared to, say, an individual stock option, you can get tax efficiency. They have a different tax treatment. Your long-term gains are taxed at basically your gains, 60% of your gains are taxed at the long-term rate, the cap gains rate, rather than your individual income tax rate. So if you're trading individual stocks, here's an example. You might have a $7,400 tax bill, 12.6% return. But if you're trading with us, your tax bill is $2,000 less in that same example, simply because you're trading in a tax efficient vehicle. There's no more itemizing as well. You get that 1099 with your P&L, and that's it. Always consult your tax attorney or advisor. And IRA, yes, absolutely. We have a lot of IRAs with us. Self-directed IRAs, that's a lot of interest these days. Even Forbes is talking about it. So we absolutely do that. And then here's a question we get: why the E-minis? Well, they're liquid, they're efficient, and they're cost effective. And what are the advantages on that? Well, it's kind of self-evident, but keep in mind, you didn't know this. Probably, if anyone knows this, tell me they already knew it, but the mini is actually huge. The S&P E-mini 500, just that one market, outtrades all ETFs around the world by over 2.5 times. That's according to the CME group and their data. So compared to the SPY, it's almost 10 times greater in terms of average daily dollar volume. So this is the activity, folks. This is where you want to be, in these E-mini markets with the futures options. More advantages: liquidity and access, volume, superior execution. So that's what that all relates to. ES options save $4 to $15 per contract. That means you get those tighter bid offer spreads on each option or each leg. Largest market share. So you have all the strike prices you need. So that's called granularity and coverage. So here's an example. You place a Dragonfly. Here's the short call and short put. And then a week later, you look at Theta Trader, and one of the Theta trades has another Dragonfly. Here's the next call and the next put. A week later, you look at another one. So you can see the strikes that you need available to diversify your position are going to most likely, I've never seen it not be available in all these years. So the E-minis are where the volume is. Now here's a big advantage. If you're doing these E-mini spreads with us, your order is placed as one trade. It's one trade, it's not being legged in. So you do a Dragonfly, so one order placed at one trade at one price. Try to do a Dragonfly trading with stocks. You can't do it. You have to break it up into two separate orders and leg into one side, leg into another spread, and then try to leg out. I mean, it's very inefficient. So cannot be done. Now remember, retail stock options traders, most retail investors only have access to the most basic call and put options. They don't have access to option spreads or other more sophisticated strategies. Well, trading with us, you do have access to that. This is institutional style of trading, and these strategies, we make it available for you. More advantages. Again, trading with us, you can just follow 2 or 3 of these stock indices, not thousands of markets. Efficient margin compared to stocks, and a clear cost structure. Nothing's hidden. These E-mini futures options, they all trade on the electronic Globex exchange at the CME Group in Chicago, the largest futures exchange in the world. Every order, if you do 1 spread or 1,000, or someone else in the world does a 10,000 spreads, your order is treated equally. Equal treatment for all orders. There's no payment for order flow. That's ridiculous with stocks. You know, they say it's free trading. It's a joke, folks. That stock options, free trading, no such thing. Let me show you real quickly. She says, most popular trading apps generate a lot of revenue from payment for order flow. They can make more money from options than regular stocks. So there is an incentive for them to lure investors into trading options, stock options. So all these places that say commission-free trading, it's baloney. It's not commission-free. Orders are executed at prices inferior to other brokers. Places like Robinhood, they get fined $65 million. You know, you're saving a penny, but you're losing a nickel, is really what it comes down to. It's just disguised commissions, that payment for order flow. So if you want the broker to work for you, pay a commission. I think this sums it up here. Kind of something your grandparents would tell you. Nothing of value is truly ever free. Absolutely. So no payment for order flow when trading with us. You pay commission, everything is clearly set out there, 5 1/4 round turn, all in, very competitive. Here, see this box here? I copied this from a big box brokerage firm, and their rates are 2 1/4, but that's only per side. And then they don't even tell you that they add more fees on top, which are clearing and exchange fees. So it ends up being higher than what we charge in this case here. So our rates are competitive. And people want to know, again, everything is net of trading cost, and these are all self-directed accounts like you would with any other brokerage firm. So everyone makes different decisions, and therefore everyone has different performance. So I see some of the questions coming in, so I'm going to get to some of these. Someone asked about heavier commissions. Well, we just talked about the commissions. Our rates are actually very competitive. What size of account? If you want to diversify with various dragonflies, condors, etc., your minimum account, 25 to 50,000 is what we suggest. And you can even get a rebate on your membership fee, 50 to 99,999. You get a 50% rebate. And then people love taking us up on this offer here. We'll just rebate the 100% of that fee with a $100,000 account or more. So keep that in mind. People love to take us up on that offer. IRA, individual, joint, corporate, trust. Now, why would you even want to do something like Theta Trader, something that's non-correlated or in the alternative space? When I say non-correlated or absolute return, hopefully most of you know what that means. Basically non-correlated to traditional asset classes. The performance of Theta Trader and the strategies being used, it won't make any difference if stocks are up, down, or sideways, depending on some of the strategies that you're using in Theta Trader. So you want alternatives because they may improve diversification and lower portfolio risk. So risk from what? Are you diversifying from what? Well, how about inflation? Look at this here. Central banks. You can see the chart here, the blue line, or the balance sheet here of major central banks. And here's the red line, the S&P index. Pretty much 90% plus correlation. But you can see now the Fed is removing the punch bowl from the party, so to speak. So it's not looking good, folks. Here's the purchasing power of a consumer US dollar in the last 22 years. Down, gosh, what, 40%. Inflation outpacing wage growth, cutting into spending. So here it is here. Weekly earnings are down 4.4% when you adjust for inflation. So even though people may be getting a pay raise, it doesn't come close to compensating for extra inflation. Percentage change in real average hourly earnings. Look at this, just falling off a cliff. So that inflation is picking your pockets. And I have a few more doom and gloom slides, so bear with me. GDP now, Atlanta Fed says heading towards recession perhaps, lowering their GDP estimate down to 0.5%. You can see the green line here, just dropping and dropping and dropping. Look at this here, imports plunging 17% in just 1 month. So I've got a lot of these here. I'm just trying to make the point that we can't just be passive and just sit tight. I'm going to show you a couple cool charts here. But look at this, Germany, much of the Euro area, has an 80% recession probability in the next 12 months. Manufacturing orders are just plunging. Look at this today, the German PPI, 45%, the highest since World War II. So talk about inflation. This is kind of like end of the world stuff there. And they talked, this is just this morning. You can see here, the Swedish central bank hiked 175 basis points, way beyond the 100 basis points expected. So that's kind of a harbinger of what other central banks may do, maybe even our Fed tomorrow. First major Wall Street bank, I think it was Deutsche Bank, calling a recession, saying the pessimists will prevail. Economy breaking hard, CEO confidence miserable, according to billionaire investor. He's in the real estate space. Lizanne Saunders with Schwab. She's just pointing out Fed has been cutting rates as GDP declined in the past, but now we're actually hiking. So we're hiking while the GDP contracts. So you can see the blue line here, the federal funds rate moving up, and the red line is economic contraction. So in percentage terms, this is what it looks like in terms of our rate hikes. I won't dwell on all this. Credit card debt soaring, largest increase since 1999. Personal savings plunging. This is the 2 and 10 year yield curve. All you really need to know is it's below zero. And when that happens, I think it's something like 90% of the time a recession follows in the next 6 months. No sign of a rebound in mortgage applications at a 22-year low. This is the graph there, what that looks like. 30-year mortgage rates moving higher. Look at the payment on a mortgage payment from November 20, just 2 years ago, 1,066. That same payment is now 2,370. Anyway, so I don't want to bore you with all this. I have a couple more slides towards the end that are more important. Single family home prices crashing down here. This is just from today. Look at this. San Francisco, LA down 3.4% just in a month for home prices. Home builder confidence declining. U.S. housing market suggesting it'll be worse in 2023, according to Goldman Sachs. Household incomes crashing. Household net worth falling. 4.1% drop, among the worst on record. Recessionary. High cost of goods. I mean, I don't want to, gosh, I sound terrible here, don't I? I guess my point is we need to come up with different solutions than just being passively long and sitting on stocks. Let me jump into something here. I'm going to get to it here. This is a good one here. Stanley Druckenmiller, if you don't know who he is, he's the real deal, folks. He says the high probability stock market will be flat for an entire decade. And why should we listen to him? His average annual return was 30% from 1986 to 2010, managing billions of dollars. Average. And he had almost no drawdowns. So those are the kind of people you ought to listen to, people that have actually managing money with real performance. That Buffett indicator here still shows we're way, way overvalued. I won't get into all these details. It's probably too much. You just never know how much time you're going to have. I don't want to drone on and on. But this is interesting here. The stock market return will be minus 3.3% a year over the next decade, according to this predictive contrarian indicator. It says 3.3% minus, according to this particular indicator. It says here, they're basically looking at household equity allocation. So at the 10-year horizon, almost a 68% probability, according to their statistics. So we like Theta Trader because it's an alternative to just sitting and being helpless. So it's a non-correlated approach. And here, again, you don't want to be passively sitting and just watching and hoping. That's not a strategy. You want to try to avoid as much of these bear market moves as possible. I mean, look at this here. You see the red lines? That's the bear markets from the past here, early 2000s, 2008. But you know, we took 6 years, or was it even like more like 10 years, I think it says here. 6 years to recover after the tech crash and 5 years after the financial crisis. And look at this, so many periods of time where markets end up going sideways. So we could very well be headed to that type of environment, you know, over the next 10 years. So something to keep in mind. And you don't want to sit on these big drawdowns because, you know, you're down 50%, stating the obvious, you have to have 100% return to get back to, you know, break even. And even that 60-40 portfolio, you think you're diversified? Well, you're not. Everything is correlated to one when things get really, really bad. 2022 was the worst year for that 60-40 portfolio. Year-to-date loss over 20% in a 60-40 portfolio if you have exposure to the total stock market index and then this other index fund here. So keep that in mind. Here you go, the lost decade for that 60-40 portfolio in the next 10 years. That's what they're suggesting. So you don't want to do this, and you don't even want to do this. You want something more like this. You need to have something in the alternative space. We think there's a lot more downside to come, probably through the first half of 2023, and you might want to use something like Theta Trader to have exposure to some bearish strategies with options. Again, all market conditions, any strategy, pre-selected spreads. You can automate your exits with the RTI. You've got those integrated one-touch trade alerts. And I see more questions. I'll get to those in just a second here. And you have the personal coaching. So you've got 5 steps here. You just simply complete that order form, cf.altavest.com/TT. Then you'll receive your login credentials for Theta Trader. You'll also receive an email with your account opening link. Of course, all the accounts are trading with us at Altavest. I see that question here too. We are the brokerage firm. Theta Trader is our technology and it's our service. So once your Altavest account is open, you simply begin trading. And again, we've been doing this 25 years with Altavest. We're regulated and we've got, needless to say, a lot of experience trading millions of these options. So one-time payment, lifetime membership, automated options, alerts, personal coaching. And let me run through some of the questions. Okay, let's see if there's anything I didn't cover. Yeah, I was talking about vertical spreads. Absolutely, we talked about. No, the dragonfly is not like a butterfly. The dragonfly would be more similar to a condor. How much does the P&L fluctuate? Matt's asking. Yeah, it's just something that can slowly, you know, work in your favor with theta decay if you're selling options, or, you know, you may end up, you know, sitting like you saw in the simulator. There are times where you're certainly sitting like on a maybe an orange RTI, elevated risk, and that would be sitting on certainly a small loss at that point, or depending how much the markets move. So it just depends, but you can look at that simulator. Someone's asking about a system, how much money to trade the system. Well, it's not a system, it's just a tool. Keep that in mind. It's an options trading tool, allowing you the power and the flexibility to do something that institutions have been doing for years. And the account size, we suggest 25, 50,000 is probably even better, because each condor is 1,000, each dragonfly is about 5,000. How many alerts? That's a good question. You know, there are weeks where you might have 3 or 4 alerts, and there are other weeks where you might have just 1 or none. It depends on the market conditions, but It's not day trading, so it's not high velocity in that sense. And that's an annual fee. No, it is not an annual fee. Gene, thanks for asking that. And trader, let's see, Matt here asked about what brokerage. We are the brokerage firm. And again, the membership fee is one time. Trade individual. Well, you are the account. So if you have an account with us, your account is self-directed. So you make the trading decisions. You decide whether to accept a trade recommendation, whether it's from an alert or whether it's a theta trade within the platform. So it's no different than a broker calling you and saying, hey, I've got a trade recommendation for you. And they tell you verbally, and then you say yes or no. Just a different way to transmit it to you. So yes, you are the trader of record. It's self-directed. And let's see here, what level? And again, everyone does something differently. Everyone wants, a few people asking about performance and wins and so forth, but everyone's going to be different in their performance. And let's take a look here. If you want to look at expected returns, you just look at each trade. That's really the way to do it. That's your best way to do it. In fact, let me jump into that real quickly. Can you be more aggressive or conservative? That's a good question. The answer is, the way to get more aggressive or conservative is you could modify a theta trade and maybe move your short strikes a little closer to the money to capture more premium, or you could just do a higher quantity for each particular trade. So you can do something like that. And we talked about, we're doing E-mini options and the advantages to doing E-mini. We are a futures and futures options brokerage firm. So hopefully that makes sense to you. And Dragonflies, someone's asking about returns and so forth. Dragonflies will always have a little bit of a smaller targeted return, compared to a condor. And that's again because you buy the additional insurance. And let's see, thanks. Oh, Gene said they've just signed up. Yeah, you'll get, let me get all that stuff here. You'll receive your login here shortly. We have to go through the orders, but thanks, Gene. And let me go, I've got some good questions. I think I've answered most of them, hopefully. If not, throw it out there again. But let me do something real quick here. I'm going to jump back. Okay, just you're back on my dashboard here. Let's zoom in here. So talking about numbers and percentages and so forth, you can see here's the November end of month Dragonfly. In fact, I don't even need to do that, but let me just show you here some of the differences. So your targeted annualized return on this particular trade is 55.2%. Now, in fact, let me look at apples to apples here. Let's look at this one here, the October end of month trade, 76.8% for the Dragonfly. And for the Condor, your targeted return is 114%. And again, that's typical. Your targeted returns will be higher on the Condor compared to the Dragonfly. And that's just the nature of the trade. The structure of the Dragonfly is going to be more robust in terms of risk, but your reward is going to be diminished at the same time. And again, that's just because here's your Condor, you sell one call, you buy one call, you sell one put and buy one put. And then of course with the Dragonfly, the structure is different. You actually end up paying money to buy an additional call and an additional put, but you can see how that can benefit you quite a bit. It's more of a slow and steady approach, kind of the tortoise versus the hare fable, right? you might consider the Condor a little more aggressive compared to the Dragonfly. So if you want to get more aggressive with your trading, you could do more Condors, or if you want to be more risk averse, you might focus on Dragons. So hopefully that helps answer that a bit. But yeah, absolutely great questions. And let's see here, anything else, folks, that I haven't thought of? I can tell you we have clients that rely heavily on Theta Trader because it's so simple, and that's the whole point. Every time I do a webinar, I get phone calls afterwards. I've got people going to voicemail right now, I'm sure, which is fine, call in or someone else will pick up. But after they use it for a while, the comment is, or even just before they use it, here's what we'll hear. I'm trading already. I've got 2 different accounts. I'm following 2 or 3 different newsletter writers and other services, and it's so overwhelming. It's too complicated. I've got kids I've got to run around. I've got work to do. I've got leisure I want to do. I don't want to sit in front of a screen all day. So if that feels like you, then you're not alone. So we get that theme. We hear that theme all the time. And that's why we came up with Theta Trader. Thousands of clients told us the same thing. So this is built for you. It's to make your life simpler, at the same time allow you access to something that would normally not be accessible to a typical, retail trader. We're trading E-mini options. So we do not, remember the advantages on the E-minis are tremendous. Lots of liquidity, lots of volume, lots of depth, execution, and the sizing there, believe it or not, in the E-minis, your average daily dollar volume is much, much higher. And there's much to say about the benefits of doing this all with one order too. So if you have, again, you can see here the 3 different strike prices on this Dragonfly. You can't place this order, like if you go to try to build the same trade at a typical stock brokerage firm and log into their platform and try to do this with the SPY, for example, you can't do this. You can't do it at one, they call it an object, but you can't do it at one price as one order. So there's many advantages to trading in the futures option space. And that's really where you want to be, to take advantage of some of these dynamics. Okay. Any other comments or questions? I think I ran through these and answered. Someone said earlier they couldn't hear, but I think it's just because we hadn't started yet. Yeah, and we do think we're headed into much more trouble. We're going to make new lows for the year, and that's kind of our thoughts. And we've been, having those similar thoughts since January. And if you're trading with us and want to kind of work within that theme, you would probably get alerts that are bearish in nature. So that might help hedge maybe some of your other portfolio that you might have if you're long stocks somewhere else, and that could be a big benefit to you. And of course, you can just purely speculate too on any direction with the with Theta Trader as well. Okay. Oh, someone asked about Canada. Sorry, folks, if you're in Canada, call me or send me an email. You see the email there, info@altavest.com. I will get that too. But let me know your situation. But typically, if you're in Canada, regulators say we can't work with you. We'd love to, though. Depends on where you are overseas as well. We can work with people out of the UK. We have a lot of people in Australia, Hong Kong as well, and even parts of the Middle East. All right. Our clearing firm is RJ O'Brien out of Chicago. It's a good question. Sorry, I missed that question earlier. Yeah, they've been around over 100 years, so they're the largest privately owned FCM or clearing firm in the world. And if there's anything else, No, futures options market is not thin. That's exactly what we were just talking about. The average daily dollar volume is 10 times greater than the SPY, and I think it's like something like two, did I say 2 to 3 times greater than all global ETFs combined. So not thin at all. This is where you want to trade. That's why you get the execution. And that's why you can have the strike prices you need that are deep out of the money to be able to build these trades. And there's market makers that provide the other side of the trade if needed. So no, it isn't the opposite of thin. But yeah, thanks for asking though, Matt. I see that in there. You want to be trading the E-minis. That's where you want to be trading. So you have the E-mini S&P 500, the E-mini NASDAQ 100, and the E-mini Russell. So those are the markets. Primarily, we trade the ES with a little bit of NQ and RT thrown in there at times. Sometimes there can be some non-correlation for a small time where you have small caps doing one thing and the bigger caps doing another. So we might take advantage of that with some sort of arbitrage. But generally speaking, you're going to look at the ES followed by the NQ and RT. And these are the markets where you want to have these multi-legged trades, not something thin, certainly not individual stocks. Okay. Oh, a few more comments. Oh gosh, you know what? There's a bunch more. I didn't scroll down. Sorry, guys. Yeah, if you want to look at returns and so forth, you just look at the targeted annualized returns, and that's or your profit potential. So that's really the best way to go about that. We can only target a return. We can't, we're not managing the money for you. It's your account. And yeah, I mean, we are here, so we're real people. And if you need some help or have questions about what trade to make or how to structure your next trade or how to, do whatever it may be, that's why we're here. So that's what we call personal coaching. You have someone who's experienced and licensed to help guide you. Spreads on option futures are wide. Nope, they're not. Not with the markets we're trading. Not with the markets we're trading. The execution is the best compared to the SPX for sure. Let's take a look here. What's the most margin the system will risk? Well, it's not a system. Don't refer to this as a system. The system implies it's, there's a robot buying and selling on your behalf, just fully automated. This is a trading platform, and the margin required in this case, for example, you see here, this Dragonfly, 45.94. So that's your margin required to place that trade. And, if you want to place a condor, just pick a random condor, then you'll notice the condor margin will be just a little less than 1,000. So just keep in mind about 5,000 margin per Dragonfly and 1,000 per condor. So 896 for condor. So hopefully that answers that question. Yes, we do have IRAs transferred all the time to us. Absolutely. So you become a Theta Trader member just like anyone else, and you will work. We work with Midland Trust. So they're very good, very efficient, and you can transfer your IRA and then open an account with us. And absolutely. And yes, doesn't matter where it's transferred from. Okay, any other questions? All right, I think that's good. Yeah, thanks, Bert, for asking. Anything else? I see Matt was asking about the spreads. I don't know what you mean by wide spreads. You mean the spreads between the sold strikes or execution? Because the execution is very tight. So I don't know. I'm not sure what you're referring to there on the E-minis. But give us a ring, give me a call, send me an email, and I can answer your questions more directly. All right, everyone, let me know what you need. You've got my phone number, and let me go right back to the other page real quick. I know we've been talking for a while, and I know we all have something else to do, but I appreciate you sticking with me. And we're going to switch screens again. Okay, there's the final screen. I'll leave that up for a second, and I'll keep checking the questions. Yeah, Matt, I see your, well, I'm not sure what system you're using. Are you using CQG or Bloomberg, or what are you looking at for? You said you don't see bid ask for. Yeah, I'm not familiar with Thinkorswim. I mean, I know what they are, but again, give me a call directly. I can answer any comments or questions about execution or whatnot. But I mean, again, we've been doing this for using Theta Trader for quite a few years now, and the execution with the E-minis is very, very tight, and there's a reason why there's so much volume in these markets. It's sort of a self-fulfilling prophecy. The more volume you bring to it, the tighter the execution. All right, very good, guys and gals. I'll let you get going, and you've got my phone number. Take a screenshot, actually. That's probably the best thing to do. Take a screenshot here. You've got the link, you've got the phone number and email. And I look forward to hearing from you, and we'll keep in touch. And for now, we'll let you go. All right. Thank you again. Bye-bye. Oh, and if anyone's still there, I see you're still there. I forgot to mention one thing. The discount does expire on Friday. So if I didn't make that clear, didn't mention it, I apologize. But the discounted offer does expire Friday. Okay, thanks again. Bye-bye.